Welcome back. You're still watching Markets Today on CNBC TV 18. Well, the fourth headline today, Gland Pharma tumbled over 14% after reporting a disappointing result for the second quarter. The margins declined on a quarterly basis from 31% to 28%. Ekta joins in now with the key highlights from the pharma company's results. Ekta, over to you.
Well, yes, definitely a disappointing set of numbers which is coming for Gland, especially on the margins. Now, the revenue declined around 3% The street was anticipating a 9% decline, so that's better than expectations. But the margins came in at 28.5% or thereabouts, and the street was anticipating at least 31 to 32% in terms of margins. Now, profit also missed estimates. Profit came in at around 240 odd crores. Street was anticipating around 250 odd crores. In terms of a couple of key points or segments, their core markets, which is basically the regulated markets, they get 75% from the regulated markets such as Europe, US, as well as Canada and Australia. That was up around 3% on a year-on-year basis, but India continued to decline because of issues such as a high base as well as supply disruptions. So last quarter it was down 70% year-on-year. This quarter it was down 40% on a year-on-year basis. But what seems to probably support Gland in the larger scheme of things is the net cash, which is still strong. So 3,800 crores plus of net cash on their books. And separately, the valuations. Yes, fresh 52-week low for Gland Pharma. It's corrected over 50% from the highs that it's seen in the past 1 year. It's trading at around 20 times 1 year forward versus peak valuations of close to around 40 times. Now, brokerages are disappointed as well. Multiple brokerages have cut their target price, though they've maintained their ratings, such as Bernstein, Goldman Sachs, as well as Incred, as well as Citi. And the likes of Jefferies has downgraded the stock to hold with a target price which is cut to around 2241 rupees as well. Brokers have said that the margin decline was largely led by a change in mix as well as competition. Bernstein says a supply resolution and new capacity should help in terms of supporting recovery. Multiple brokerages have cut their EPS as well as earning estimates.
Okay, stay on, Ekta. Many more updates from the pharma space today. Both Glenmark and Lupin were on our radar as well following the latest US FDA observations. Tell us a little more about that.
Well, it seems as though the US FDA regulatory risk seems to be re-emerging for a lot of the pharmaceutical companies. So for Glenmark, the fresh news is that their Baddi facility has received an import alert from the US drug regulator. What an import alert means is that fresh products from this particular facility or drugs from this facility will not be allowed into the US markets. Now remember that this particular facility was already on the fence for Glenmark. It had a warning letter issued to it in 2019. It was re-inspected in June 2022. It received 6 observations then. After that, in September 2022, the US FDA did say that the official action indicated status will continue on this particular plant. So the street was anticipating that yes, it could be set for some amount of bad news, and that's exactly what's happened. The Baddi facility is only around 1 to 2% of their FY22 US sales, but it puts into light the risk of other regulatory actions on Glenmark, because Glenmark in the past has had quite a clean record when it comes to regulatory risks, and this probably makes investors fear that there could be other issues which might emerge in the future as well. For example, their Goa facility, Monroe facility too, have some regulatory risk outstanding currently. Lupin, separately, CNBC TV 18 accessed the Form 483 which was issued to their biotech facility in Pune. They received a whopping 18 observations for that particular facility, which was inspected just in the month of October. And the observations, for example, around aseptic processing, monitoring, lack of adequate product evaluation, remedial action on actionable microbial contamination. So the street is fearing that it could be probably a longer road ahead and doesn't bode too well on a larger scheme to receive 18 observations for a biotech facility.
Okay, thanks a lot, Ekta, for that. Well, the fifth headline today, metal stocks rallied in trade on the back of positive global cues. The Nifty Metal Index gained over 2.5%. Meanwhile, prices of gold, silver and copper also surged higher. Manisha Gupta joins in with a wrap of the key reasons behind the big metal rally. Manisha, over to you.
Well, it has been a good day for metals as an underlying commodity for Nifty Metal and most of the metal stocks as well. And that is because of the decline in US dollar index, now trading below 110 5% off from its 20-year highs that we saw in the month of September, and that clearly has been supportive for the dollar-denominated commodities. Take a look at copper, and we're trading at a 6-week highs on this one. Aluminum is trading at more than a 1-month highs, and when you look at this week itself, copper is up by 3.5%, aluminum is up by 7% as well. The alumina production globally has declined as well, is what International Aluminum Institute report suggests. So when you look at the fundamentals, they are on the stronger side, and the markets do believe that demand going forward also will improve as more and more central banks are getting less hawkish. We've seen that already from Bank of Canada, the US Fed, while the 75 basis point rate hike for the month of November is factored in, but the expectation is that for the month of December, US Fed will stop at 50 basis points. That is where the high probabilities are. So the demand for one will see some improvement. The better Chinese data also are suggestive of the fact that you are looking at better demand there as well, at least on ground. Stronger fundamentals, weak US dollar, less hawkish central banks, all of that is something that improved the sentiment within metal prices today, while they still are 35 to 40% off their 2022 highs. But when you look at the last couple of sessions, the last 1 week itself, there is a lot of positive moves that we have seen come in the space.
All right, thanks a lot, Manisha, for that. Well, BEL was up close to 3% today after reporting an 8% rise in its consolidated revenues. This entire space, defense, has done exceptionally well. Vahishta is here with more details on that. Vahishta.
Well, Bharat Electronics has reported the Q2 FY23 numbers today, and the revenues were up by 8% on a year-on-year basis, which was driven by a pickup in the execution pace and a revenue spillover from Q4 of FY22 to FY23. Now, the EBITDA margins have come in at 22% in this quarter, which are nearly same as the street estimates. However, the order book position as on the 1st of October 2022 is at 52,795, which is down 5% on a quarter-on-quarter basis and also has declined 3% on a year-on-year basis. So actually, the order book position is the one which has been worrisome because it's come in at a 2-year low.
Okay, thanks a lot for that. And more earnings updates. PCBL tumbled over 8% after a decline in operating profit margins for the second quarter of the fiscal. Chennai Petro declined 12% after disappointing performance. Sonal is here with the details. Sonal.
So let me start with PCBL or Philip Carbon, where it was a big margin miss. Yes, revenue grew 52%, but EBITDA declined 1%, leading to a margin decline of almost 600 basis points and profit decline of 4%. Now, the company in its conference call said that yes, volumes were impacted in Q2. It is largely because of capacity constraints. They do have a new facility coming up in December 2022, and the peak utilization levels for this particular facility will be reached in next 2 years. They have a sizable exposure to Europe. The total carbon black market has an exposure of 18 to 19%, and just for companies' exports, it's around 15 to 16%. So whatever we've been talking about, power shortage, higher power prices, that is something which impacted production in Europe for Philip Carbon, and hence the decline in margins as well. For Chennai Petro, it was a howler of a quarter, largely expected because GRMs had fallen down, the Singapore GRMs that is. This has led to a revenue decline of 16%, EBITDA down 93%, margins have come in at 1.2% versus 14.7%. There was a forex loss, there's an inventory loss because crude prices were down, and profits are down 99% on a quarter-on-quarter basis. Even GRMs for the company at $4.50 per barrel versus $25 per barrel on a quarter-on-quarter basis. So a big slide in the stock price as well.
Okay, thanks a lot for that, Sonal. With that, it's curtains down on this edition of Markets Today. You folks have a great evening. Thanks a lot for watching.